Welcome to The Explainer. Today, we're digging into a really interesting analyst report on the semiconductor maker Huahong. We're going to figure out how a company can have this amazing, glowing future and still not be a buy. How does that work?
Okay, so let's just jump right into this quote from Goldman Sachs. On one hand, they're saying they're positive on the company's long-term potential. But on the other hand, however, neutral rating. It sounds like a total contradiction, right? How can you be excited about a company but tell people, maybe just sit this one out? Let's unpack the logic here.
All right, so first up, let's look at the good stuff. Why are the analysts so optimistic? Turns out there's a really strong case that Huahong is absolutely crushing it right now and is set for some major growth.
And the first big clue is this number right here, 108.3%. Now, that's their factory utilization rate. And you might be thinking, how can you be over 100%? Well, it means their factories aren't just busy. They're running beyond their official max capacity. They are squeezing every last bit of production out of their machines.
So what does a number like that really signal? It's a sign of absolutely white-hot demand. I mean, the company is selling every single thing it can possibly make, and there's still a line of customers out the door waiting for more. It's a fantastic problem to have.
So where is all this demand coming from? Well, it's not just one thing. It's kind of like a perfect storm of three huge trends hitting all at once. You've got this big push for local supply chains, you've got a massive recovery in things like smartphones and EVs, and then there's the AI boom, which needs a ton of the exact kind of power chips that Huahong specializes in.
And you know, the company isn't just sitting back and enjoying the ride. They are hitting the accelerator hard. To keep up with this incredible demand, they're in a massive expansion phase, boosting their production capacity by a whopping 14% in just a single year. I mean, so far, this story sounds amazing, right?
But, and this is a big but, here's the twist in the story. You know the saying, it takes money to make money. Well, all of this fantastic growth and all this expansion, it comes with a pretty hefty price tag.
And this slide, this really gets to the heart of the whole puzzle. Because even though the company is on track to make a ton of money, that's the revenue, they're actually expected to keep less of it as profit. So more sales, but less money in the bank at the end of the day.
Wow. And the numbers here really drive this point home. Take a look. The revenue forecast for 2025, completely unchanged, rock solid. But look at the net income, the actual profit. They've slashed that forecast by a massive 33%. A third. They're making the exact same amount in sales, but they're going to be a third less profitable.
So where is all that money going? Well, the profit is basically getting squeezed from three different directions. You've got the day-to-day costs of just running these bigger factories. You've got massive investments in R&D to stay ahead of the curve. And of course, you have to pay the interest on all the money you borrowed to build those new factories in the first place.
Okay, so you've got this tug of war, right? On one side, amazing, soaring demand. On the other, these rising costs that are eating into profits. So how in the world does an analyst take all that, the good and the bad, and boil it all down to one single number, a target stock price?
Well, it's actually a pretty standard recipe they follow, and it has three main steps. First, they try to predict how much profit the company will make for each share. Then, and this is the tricky part, they decide on a fair price to earnings multiple. And finally, they just multiply those two numbers together. Boom, you've got a target price.
Now that second step, finding the right PE multiple, that's where the art really comes into it. They don't just pull a number out of thin air. They look at all the other big players in the semiconductor world, their global competitors, and see what the market is paying for their earnings, especially based on how fast they're expected to grow. It's all about finding the right comparison. And get this, here's another twist. After the analysts updated all their data for the whole industry, they actually decided Huahong deserved a higher PE multiple than they thought before. So what did that do? It made them raise their target price for the stock by almost 14%.
Okay, wait a minute. This brings us right back to the puzzle we started with. Demand is booming. The business is growing like crazy. The analysts just raised their official valuation. So why on earth isn't the rating a buy? Why isn't this a slam dunk?
All right, here we go. This is the final piece of the analysis. This is the moment where that carefully calculated theoretical value of a company crashes right into the messy reality of the actual stock market.
And it all comes down to this. The analysts' new higher target price, what they think the stock is actually worth, is $53.40. But at the time they wrote the report, the stock was already trading on the open market for $56. The stock was already more expensive than what the analysts thought it was fairly worth.
And that brings us right to the punchline, straight from the report itself. Because the stock's current price is already higher than their target price, there's no room for it to go up. There's no upside. All that good news we talked about, it seems the market already knows about it, and it's all baked into the price.
And really, that's the big lesson here. A great company is not always a great investment. They are two totally different things. You can have a company that is firing on all cylinders, set for incredible growth, but if its stock price already reflects all of that future success, well, there's just no room left for you, the investor, to make a profit.
And that leaves us with one final thought to chew on. In the world of technology, everything can change in an instant. So what's the one unexpected thing, the one true breakthrough that could come out of left field and make all of these careful calculations totally irrelevant and turn this neutral story into an absolute blockbuster overnight?